Buying a home is one of the most nerve-wracking decisions that you'll ever make. Why? Because it's not just a purchase. You're about to go into debt to the tune of hundreds of thousands of dollars. And the fear of the unknown is very real. One mistake could cost you tens of thousands of dollars. So today, we are going to go into the top 5 crucial mistakes that home buyers make. And whether this is your first purchase or your 5th, doesn't matter. This is going to apply in any market, in any season. And let me be clear, we're not going into the fluffy stuff today of get pre-qualified, get a home inspector. If you want that, you're gonna have to go watch somewhere else. Today, we're diving into stuff that no one talks about. We're gonna get personal, and along the way, we're gonna try to save you some money, some time, and a lot of stress. One mistake home buyers can make is simply relying only on their pre-qualification to figure out how much home that they can actually afford. You see, if you're an employee working at a company like Amazon or some other company, you're gonna go talk to a mortgage specialist at a bank like RBC, or you're gonna go talk to an independent mortgage broker. And what they're gonna do is take your annual salary, your annual gross salary specifically, and they're gonna take that and use it with 2 calculations that lenders look at, which are called the gross debt service ratio and the total debt service ratio. So we're gonna get into those in a second because they're important, but what I want you to think about is, well, what's the difference here between my gross annual salary and my net annual salary? Net being after taxes and deductions, because that's gonna be a better measure of what you can actually afford, right? Okay, we're gonna come back to that. But for now, gross debt service ratio. So this, your GDS here, is gonna include all those housing related expenses. So your mortgage payments, which would be, the principal plus interest, and then you're gonna have your property taxes, your heating costs, and if it's a condo or a townhome, you're gonna have your strata maintenance fees. And so we wanna see that number, let's call it $30,000 a year, and we're gonna divide it by your annual gross salary. So if it's 30,000 and you're making 100,000, now you're looking at 30% for your gross debt service ratio. And the lenders wanna see that number under 39%, so you'd be okay in this scenario. Now, the other measure that they use is your total debt service ratio, and that includes all those housing related expenses, but also any other forms of debt that you may have. Let's say you've got a car loan and you got payments to make on that, or you've got student debt, these type of things. So let's say you've got $5,000 of extra debt payments on top of the housing related ones per year. Now you got 35,000 divided by the 100,000 and you're looking at 35%. And lenders want to see that total debt service ratio under 44%. So you'd be good in this scenario. But remember, these calculations are based on your gross income, and your actual take-home pay is going to be different, right? That determines what you can truly afford, and you got to factor that in. And you got to factor in your lifestyle expectations, things like vacations and Christmas presents and all that kind of stuff, right? So what I would suggest is you go and create your own affordability budget that includes all those monthly expense items and things that you're thinking about, so you're not stretched too thin and end up, house poor. The second biggest mistake that home buyers can make is sort of related to the first one, where you've got to protect yourself first. You got to work out some of those numbers before you go talk to the real estate agent or the mortgage broker. And so this second one is not having enough savings for anything beyond the house. So most of the time you go talk to a real estate agent or a mortgage broker, we're going to tell you to have saved up for 2 things: your down payment and your closing costs. But if that's all you've got money for, what about those unforeseen things that come up in life? So let's get into that in a second, but before we do, down payment and closing costs. So down payment, if you're going to have an insured mortgage, you can have as little as 5% down. But if you want to go to the gold standard, where you don't have to pay for that extra premium of insuring that mortgage, you have 20% down. Now, on top of that, you got your closing costs. And this is going to be your property transfer tax, your legal or notary fees. You also want to think about sort of earlier in the process, you're having money for a home inspection. And then you got to think about moving when moving day comes. Those are all things that cost money. The big ticket item here on your closing costs, though, is the property transfer tax, which is 1% on the first $200,000 and 2% between $200,000 and $2 million. So something to think about here. Now, moving on, what about these other two buckets that I think you might want to have some extra savings for? Life just has a way of sort of coming at you, right? You got unforeseen things that could come up. Now, whether that is, let's say you move into the home and a couple months later, the washer or the dryer goes. Now you got to replace those. You want to have some money set aside for that. Same thing with like maybe your car has a issue that comes up. You need to have some money set aside for these extra unforeseen expenses. And I would suggest just having one extra bucket there for some of these miscellaneous things in life that could come up. So I'm sure you could use your imagination and come up with stuff that it could cost. For me, I'd be thinking about family members. Maybe we need to give some money to mom, or because she's had an unforeseen cost come up, or something like that. So I would suggest you have a 2 to 6 months emergency fund separate from your house savings to cover unforeseen costs. And this will give you some peace of mind and really the financial flexibility that today's life really just demands. The third biggest mistake that home buyers typically make is not having an established timeline for their home buying process, okay? Because a lot of the times people will just call up a realtor they know and say, hey, what does this process look like? Well, don't start there, because what you got to do is actually work backwards from when you want to be in the new home ideally. I get it, you're probably not in a rush, but yeah, in your mind you're going to have some ideal time of when you want to move in potentially. Maybe that's before the kids go back to school in the fall. Maybe it's you want to move just after they get out of school, before summer, whatever it is for you. So it's not a quick process. It does require some planning, and here's a general timeline for you. First, you're going to get that pre-approval from a bank or a mortgage broker, and that can take 1 to 2 weeks, right? You got to do things like gather all your financial documents, maybe get a letter from your employer to say that you actually work there. The biggest hold up in this stuff is usually it's going to be the client sending those financial documents to the mortgage professional. Okay, so that's going to be 1 to 2 weeks. Next, you're going to find a home, and that could take you, usually maybe 2 months. It can happen as little time as a week, 2 weeks, but let's say 2 months, maybe a little bit more. It all depends on what you're looking for, where you're looking for it, and then what your budget is. So we've got our 2 months there. Next, we got to do our due diligence, right? We've got our offer accepted, and we're going to take 1 to 2 weeks to do that due diligence, home inspections, get the financing approved for the home, review all the strata documents, and talk to an insurer to see what your home insurance is going to look like. So that's 1 to 2 weeks, and then you're going to close on the home. Now, this can happen really quickly. It could happen in as short as a week, 2 weeks. If it's a week, the lawyer handling the transaction is not going to be happy with you. They like to have more time than that. But, normally 30, 60, 90 days on the really far out end of it. That's going to be about how much time? Maybe think of 4 to 8 weeks. So we've got 2 months to close on the home, 2 months to find the home, and 1 to 2 weeks to do your due diligence. So you're really looking at about 5 months here to get this whole thing worked out, right? So things can get held up even more though. What if during the process of getting pre-qualified, you see that your credit score is not good enough and you got to do some work to correct those errors and repair your credit score? That could take some extra time that we're going to have to insert there. What if you're getting gifted funds or you're bringing money over from abroad? That's going to slow things down too. The bank's going to want to see that money having sat in your account for normally it's like 60 to 90 days. I've seen 30 days before, but that's going to slow you up as well. So if you're working on repairing your credit or you're getting gifted finances, just know you've got some extra time you got to build in there. Many buyers, they're going to end up rushing at the end because they've got to be out of their rental property or some other personal things coming up like a vacation or whatever. You don't want to compromise on these key steps like proper due diligence and making sure that the financing is 100% confirmed, because these are some costly mistakes that you don't want to make. You want to avoid them. So plan your timeline in advance so you can make some informed decisions without feeling rushed. The fourth mistake that buyers can commonly make is chasing that perfect house or the one that's brand new to market and super popular. You don't want to chase this golden egg if you can avoid it. See, when a home just hits the market, it can often attract a lot of attention, and sometimes you end up in a bidding war and the price can get driven up. And a bidding war is super stressful. I bought my own first home in a bidding war, and you know what ended up happening? I ended up overpaying for it because it was perfect for what we wanted, but I didn't overextend myself. I was okay to pay a little bit more because that was the home I wanted. But what I would suggest that you look at doing instead, any given week, if you're looking for a particular home in a particular neighborhood, a few homes are going to hit the market that roughly fit those criteria, right? And then you're going to get to the weekend and open houses, and you're going to go around and look at them all or have private showings set up. Now, the most popular, most shiny one, that's going to have the most attention. I would suggest you go and look at them all. And if it's a really hot market, and things are moving really fast, maybe go look at those second and third options where you might get a better deal. Maybe you got to fix up a few things. Maybe it's not 100% of what you want. It's like your second choice. But hey, if you can get a much better deal on that property and avoid the stress of a multiple offer where you have to get all your ducks in a row really fast, and you're not someone who likes to make fast decisions, or you're not willing to pay a little bit more than maybe you should and you want to get the best possible price, I go look at those other ones, because buying a home in a multiple offer and overextending yourself will really stress yourself out. It's going to strain your finances, and it's going to leave you not much room for other expenses. So focus on a property that meets your needs and budget. Look beyond what's trendy or popular. Consider the neighborhood, the commute, the amenities, all those things that align with your lifestyle. The fifth and final mistake that buyers commonly make is buying a home with future equity gains in mind, especially in the short term. I can't tell you how many buyers, particularly first-time home buyers, I've met who have this fantasy that they're going to buy this property in whatever area and that it's going to go up tremendously in like 2 to 3 years, and they're going to sell it, and then they're going to move into their dream house, dream neighborhood. It doesn't always work like that. Those are the outliers. Now, we have had a great decade in real estate apart from the last 2 or 3 years where it's been a little soft. We're in January 2025 right now, but it's not always going to be like that, okay? You have got to buy into a property that you can see yourself being there for 5 to 10 years, because relying on rapid market expansion is risky, and especially if that property doesn't perform as you've expected, because selling it too soon is going to cost you the commissions, which is not a small dollar figure, and then buying the next one's going to cost you in property taxes, which also not a small number, right? And those closing fees on top of that. It's expensive to transact in real estate in British Columbia. So whatever you do buy it with the mindset of I'm going to be here for 5 to 10 years at least. And hey, if the market outperforms and you see an opportunity, that's great. Take advantage of it. But you can't have that at the forefront of your mind for why you're buying a place. You got to really be prepared to stay in it for at least 3 years. I would suggest you look at more like 5 to 10. Think long term, plan to stay in that home for that time, so you can build up some equity and naturally offset some of those costs like commissions and taxes. Buy a home that fits your lifestyle, a home that fits your budget, and not a home that you think is going to generate quick profit. Okay, so what are we going to do? We're going to avoid those 5 costly mistakes. We are going to understand what our take-home pay is and how much we can actually afford in the home that we want to buy, not what we're only pre-qualified for. And that means thinking about our gross debt service ratio and the total debt service ratio and our net income rather than just our gross income. We're going to save some money for emergencies because life happens. We're going to plan out our timeline and think of when do we ideally want to be in that next home, and then we're going to work backwards from that. And we're going to think about focusing on value over popularity, right? We're not going to chase the golden egg here. And lastly, we're going to think long term. We're going to think about a home that we can live in long term and that's going to serve us. And then later, when the timing's right, we can make the jump to the next property that we want to be in. So in my next video, I'm going to share my personal home buying mistakes and how they helped me become a better real estate agent. So you're not going to want to miss that. So these are just 5 mistakes that you could potentially make. I'd love to hear in the comments what are some other mistakes that you think we should watch out for in our home buying journey. Maybe you've got a horror story that you want to share so we can all learn from it. So drop those or any thoughts you have in the comments before. And if you like this video, it's a huge favor and click the like button. If you never want to miss another one of these videos where you get tips and market updates and property tours, just subscribe.